is Invisible Inc., the podcast for under-resourced women entrepreneurs. And I'm your host, Shubha Chakrabarti, founder of Achieve. Join me as I talk to women entrepreneurs about the nuts and bolts of their journeys and to experts who will give you insights that are hard to find anywhere else. Let's jump in. What important aspect of your startup has an outsized impact on your fundraising outcomes? Why is it so hard to change VC investment patterns in women-founded startups? What do founders often miss about the investor side of startup funding? Our guest this week, Julie Castro Abrams, managing partner at How Women Invest, started an ambitious project that addressed the triple whammy of low corporate board representation, lopsided investor participation, and of course, abysmal VC funding to women founders. Listen to her sharp insights on why product-focused startups find it harder to get funded than software or tech startups. What happens when women start making the investment decisions in startup funding? What critical aspects women founders must nail prior to fundraising, and much more. Now, here's Julie. Hello, Julie. Welcome to Invisible Inc. We're so excited to have you here.
I am so thrilled to be here with you.
Great. So you had a pretty interesting journey to where you are today. What got you interested in the startup finance world, and how did you end up starting How Women Invest?
So I actually came to this through an interesting pathway. I started my career really thinking about how do I solve for issues of poverty and injustice and inequity for women. And so one of the things I really realized is owning your own company is one of the most powerful ways for you to own your power, to have people respect you. And I worked with low-income women to start their own businesses and did microloans for them for 11 years. I ran a type of a bank. And it was amazing to see, like, when women would be like, domestic violence survivor says, I'm the CEO of this company. Everybody changes how they react to her. Her own self-definition gets reinforced, and it changes everything. And so when I was doing that labor of love, that mission, that nonprofit, actually, one of the things I realized is there was a big problem when somebody was ready to scale. There's no money available in venture. Only 2% of all companies founded, of all venture funds actually go to companies founded by women. So the numbers are really quite anemic. And I started to research it and think, well, why? Well, these are private institutions that are making venture investment decisions. They're almost all run by men. And venture capital is a trust and pattern recognition business more than anything. And so you trust people who look like you, who you understand. So I'll give you an example. I cannot tell you how many men who run venture firms that I've talked to, when they get like a medical device for women or something that's designed for women, if they even look at it at all, they'll say, oh, let me ask my wife or my daughter. It's like, that's not a reason to fund something. And so the fact that we don't have enough women making decisions in venture and making financial decisions overall in the United States actually means we're leaving huge market opportunity for job growth, economic growth for the country on the table. In fact, Morgan Stanley did a research study and they found that we were leaving $4.4 trillion of potential earnings for us as investors, for you and me, and everybody on this call. We're not making that money that we could be making as a country. And we're also not getting the products and solutions. So like one of the companies that we're investing in is a menopause solution. There's so much shelf space for menopause solutions because they're so underfunded. It's a big opportunity, and we're fueling somebody that's going to take advantage of that opportunity.
That's pretty interesting. So tell us a little bit more about How Women Invest. What's unique about it, and what's the model?
Well, because I want to solve for this fact that only 2% of all venture funding goes to companies founded by women, male-female teams actually get more funding. I think it was 17% the last time I looked. So we said we are only going to fund companies with women founders and no male co-founders. So for us, that is the most important filter. And we started with one fund. We've got a second fund up and running. I'll start raising my third fund soon. So we're on a mission to be assertive about our growth and to really make change.
You mentioned a really interesting point about the mixed gender founding teams and the sole women founded teams. What caused you to make that distinction?
Well, one is that women are told if you don't have a male co-founder, you can't get venture funding. And it's actually true. It's not true completely, but it's much harder. So we're trying to address that kind of inequity where no woman should ever hear that. We want to actually have it feel like the opposite for people.
One of the things that you talked about, and I was looking at your website and reading up all this amazing stuff that you have in all of your sites, how women lead, how women invest. And you place a lot of importance on gender lens investing. And there's a lot of different definitions out there. There's an impact movement talking about gender lens investing. How do you, from your perspective, define gender lens investing, and how does that play out in how you do your work with how women invest?
I mean, literally, it's what I just said. We are purists. We only invest in companies that are founded and led by women. And so that is our lens. And we have a couple other things that we focus on. One is we try to get 50% of our portfolio companies are women of color. So our deal flow is 50% non-white women, which is fantastic because in the United States, if you think the numbers for women is bad, the women of color get way less. Of course, everybody has equal skills and hard work and the whole thing. So that means we can get the cream of the crop, like the people who are the most badass, amazing leaders. We can fund them. Now, this doesn't solve the whole market problem. And so we're on a mission to get more women investing in venture. In fact, I have a goal to get 10,000 women to say that they're going to invest in venture capital. We also want to fund and support women-run venture firms that are struggling to get both funding and to scale and really sort of connect them all.
Yeah, I saw a great feature by one of the professors from Chicago Booth on that precise point. So glad to hear that you guys are addressing that. You've had a lot of experience in this whole field. So I want to talk about sort of the broader funding issues women face. Lots of problems, but if you look at the funding side, you mentioned earlier very briefly this point about if I don't understand the product, then I'm not going to fund it. Or if somebody in my family says yes or no, that's going to be the decision factor. Is that the biggest funding issue, or are there other bigger issues that you see that are causing this capital access problem?
Well, capital access for women is not just venture capital. Venture capital is the tiniest sliver. So if you're talking about all across the board, women aren't getting loans to start their own businesses. I mean, there's so many different products and tools out there in the marketplace that women aren't getting access to. And there's structural issues for that. And one of the things is credit analysis. How are we deciding who is credit worthy? What are the real indications? Because just using a credit score is not proven to be an equalizer in this country.
Is it just bias, do you think? Or like if you had to pinpoint it to one thing, what's your instinct about that?
Well, what I know is that all of our current financial structures were designed by and for men. If you think about it, in 1988, there was a law that was passed, and it was a big deal. It was HR 5050 in the United States. That was passed that said women could take out commercial loans without getting their husband's signature. That's not that long ago. And commercial loan application processes haven't changed at all, really. So if you think about it, every system is designed really by and for white men. And what we've said all along is, hey, women, you need to fit in these structures when in fact, men have unequal advantage and opportunities, and the lens of how you look at something a man does is different than how you look at what a woman does. Women are more capital efficient and performance driven. We return more for our investors. But what we do in venture is we look at male-female teams or pitches. We want the big, audacious, bombastic pitch. That doesn't lead to success. That doesn't mean financial returns, but that's the bad pattern that we have of how we decide who we're going to invest in. So people will say to women, you're not thinking big enough. You're not pitching in an exciting enough way. And then on the other hand, we'll ask them, there's good documentation of this. Women are asked questions about how they're going to prevent risk. Men are asked questions about how big can this get. So women are told you have to be like men, but then there's not the same measuring stick. Like all along, the process is broken. But when you get women who are deciding in venture, they invest in women equal to the applications they're getting from women. It's not necessarily good for men either that we're only reinforcing the bombastic behavior. We've seen the disaster of that in the markets, right? This is a crisis of leadership. It hurts people and it's not good for investors. And so we need to change how we think about success and leadership and what we reinforce. I don't know how to get men who've been successful in their own minds in how they've built their venture investing career or otherwise their decision-making criteria. I don't know how to get them to change because we can't regulate it because it's a private market. What I know is we need more women investing and making decisions in venture. So let's say you're listening to this podcast and you aren't going to go start a venture firm. You could take your retirement funds, a reasonable 5 or 10% of your invested assets, right? Your retirement funds or a donor advised fund or cash you want to put to work. You can invest any of that in a venture fund. Most people don't know that. And when you invest, all you have to do is ask good questions like, how many women CEOs are in your portfolio? If enough of us ask those questions, people will start to change their behavior. The other thing you can do is decide you're going to invest in venture funds with women decision makers and partners, or focus specifically on women, which there are about 300 women-run venture firms right now in the country. Most of them are brand new, and they're in the last 5 to 10 years.
And you bring up a really important point. So earlier you mentioned women run more capital efficient businesses. They've been forced to, so that makes sense. And you also mentioned, I've seen the research that shows that the returns from women run and women founded businesses are better. If you kind of connect the dots, venture firms are fiduciaries. They owe the duty to allocate capital to what makes the most money on the one hand. And it almost feels like they're violating their fiduciary duty by engaging in this behavior. What explains the paradox in your mind, and how do LPs not see that? Or what's the disconnect that I'm missing there?
2 analogies. One is there was a point in time when orchestras in the United States were all men. And then there came a point, there's a story about how someone's cousin or some family member was going to audition. So they did a blind audition. And the person that they chose ended up being a woman, not the cousin or the whatever, right? But actually a woman. And they were like, wait, they weren't trying to only pick men. Our bias is so deep, their ears played a trick on them. They thought the men sounded better. Now that blind auditions are ubiquitous, everybody uses blind auditions. I don't know what the data is today, but over 50% of all people in orchestras are women because of blind auditions. So you cannot regulate the private venture funds necessarily. What I would like to see is some public institutions that are major venture investors, like pension funds and endowments and foundations, who have a responsibility, both fiduciary responsibility, but also the people whose money they're actually investing. They're largely women and people of color. So what I would like to see is them holding them accountable for it. But one other example of when we were able to regulate something, in 2010, about 10% of all public company board members were women, 90% men. And we had disaster after disaster as a result of groupthink, where people who are all like each other on a board, and I'm on your board and you're on my board, yeah, that's fun, but it's not good fiduciary responsibility. So what happened is the data started coming out and we started to realize diverse boards, product recalls happen 3 times faster. Less people could die because you have different people in the group saying, how are we going to handle this? And we don't all defer in groupthink to that one person, let's say. So today, after the asset management firms like BlackRock and State Street and Fidelity took a stand and said, this is not good for our companies because we end up dealing with a financial fallout when there's a crisis, they started requiring public company boards that they invest in to have at least 2 women on their boards. That started a big change. And then we put legislation in place in California where the majority of all of the new IPOs are coming from in this country. We started to say, you have to have 3 women on your board if you're a public company and have 6 or more board members in California. So today, 32% of all public company board members are women. Now, we know that protects companies. They have better returns. They handle crises better. And it had to be forced because literally people would say, I heard men saying this all the time. What, are they just going to put secretaries on the board? Like, they really didn't think women were qualified. And furthermore, they had a belief. It's not bad that someone thought this, but it's just wrong. They thought you had to be a CEO or a CFO to be on a public company board. Well, now today, 10 years later, when we've gone through a transformation, one of the things we're finding is you actually need to have some people who are operators who are younger. Otherwise, you don't know what's happening with tech. You are not on the cutting edge. Somebody who was a CEO 12 years ago and is only serving on corporate boards today, you can have one of them on a board, but you shouldn't have your whole board be that person. You need diversity on your board. Diversity upgames everybody. So if we use those, an orchestra and corporate governance as examples, we need a disruption in venture. It's not good for financial returns, and it's not good for the economy.
Very instructive. I didn't know the story about the corporate boards. So you talked a lot about the funding side. That makes a lot of sense. I want to turn the lens slightly into the demand side. You clearly have a lot of interaction with women entrepreneurs and founders. Have you seen any repeating themes or issues that might be causing the problem of access from our demand side, i.e. from the entrepreneur side?
Well, it's not the entrepreneurs that are the problem. What's kind of interesting is when I first started this venture fund, I talked to some people, including some women VCs, and they said, oh, there's not enough women creating high growth venture backable companies or high tech companies. They're all creating skincare companies, right? Nothing wrong with skincare. I use skincare products. That said, when I had seen enough, I was like, well, that doesn't make any sense. That's baloney, because I'd been investing privately myself. Well, now we saw 500 deals last year. 58% were non-white founders. And these women have AI companies that are literally creating a personality avatar so that you can be in two places at once. We've got serious financial tools. We invested in a company that's created, how do we describe this? They're trying to put power grid investing and created a hedge fund so that we can predict the cycles and we can be sharing energy in different markets. I'm solving for a critical, technical, super financial, all these PhDs that I get to see are super fun. So what I want you to know is women are starting the right companies. What happens is they have to pitch more. It's distracting from them running their companies. 85% of women pitching report sexual harassment when they're pitching their companies. So what ends up happening is women say, this is ridiculous. I'm going to just bootstrap it. I'm going to grow a slow growth company because the cost is too high. And the likelihood that they even get any funding is so low. So I think the market has a problem. It has nothing to do with the women. We need a new day where more of us are investing and deciding in venture.
That is a scary and sad statistic. I hadn't heard the 85%. So thank you for shining the light on that.
Shubha, my friend, Senator Hannah Beth Jackson in California, had to literally author legislation in order for us to make it illegal to sexually harass someone when they're seeking venture funding, just like in a job. We had to pass a law to say that's not okay.
Clearly, that has to change. I love how you talked about this value of diversity. And I know that one of the unique aspects of your model is that you're also seeking to bring in more women into the investor fold and thus kind of bringing that change more upstream. Can you talk a little bit about what prompted that and what are the biggest learnings you've gained through bringing more of these women? What have you seen? What have you learned from that process?
I've learned so much. It's been fantastic. Here are a couple of things. I have a network at How Women Lead of top executive women like you. So we have 17,000 women who are engaged on a regular basis. And I got 155,000 people following what we're doing. So we got a big audience. And the vast majority of them are in the C-suite in a company or on boards, like they're superpower players. So one, when they invest with us, and this could be with anybody, but when you invest in venture, people literally say, oh, people have seen me as the general counsel, but now that I say I'm a venture investor, all of a sudden they're like, oh, will you go on my board? So one thing I'm realizing is it's a big power play. The other thing that I'm realizing is we just put it out to our network and said, if you're an accredited investor, which is not an extraordinarily high bar, you have to make $200,000 a year for the last 2 years or 300 as a family, or have $1 million like in your retirement account outside of your home. So right there, that is a leveling of who could invest. And so of the women who've invested with us, 85% have never invested before. And of those 85%, within 1 year, 30% are now investing in another venture fund and up to 3 additional venture funds. So one of the things we know is women need to be invited in. People are telling me no one ever invited me to invest in venture before. I've been hanging out with all these VCs. I'm making $2 million a year. I had an exit. Like people with some significant resources. There's a bunch of white guys who are quite bombastic and ego-filled, is unfortunately what we usually see in venture, not everybody. And therefore, when you have this opportunity to invite women in and demystify it, and our minimum investment is just $25,000, and you can spread it over 4 years, so it's just $6,250 a year. That's pretty darn accessible for most women, especially if you're thinking about using a retirement account or a trust or something. So it's an easy on-ramp. Even if someone has a lot of money, you don't want to be irresponsible and make a mistake. So if you make a mistake on $6,250, it's not the end of the world for most people that are involved with us. So I just think it's an easier decision tree for them. And once they do it with us and they feel confident, they see the companies are selling and being successful, then we can.
I think that's a natural segue to the actual investment process itself. And from a founder perspective, just overall, from what you've seen, what you've experienced, what guidance would you give to a founder in terms of how they pick a potential VC? And we'll focus on VCs for this conversation. Yeah. How should they think about VCs and what are the factors they should consider? And how should they evaluate and screen out VCs that might not be a good fit or a good use of their time?
Well, first and foremost, I would say you need to know what a VC is looking for. Sometimes I get companies, and men and women all do the same thing. So it's not a gender issue. But with some frequency, someone will contact me and it's not really a venture backable company. And you need to understand how venture works. I raise money from people. I have a responsibility to make investments that will return money to those people. But there's some layers of fees and stuff. So I have to see when I make an investment, because there's risk and somebody could go out of business, right? You can count on that. I need to be able to see a 10 times return profile. Okay. And I need to believe that in 5 to 7 years, they will make that exit or have some kind of an event where I could make that money so I can return it to our fund, which is a 10-year fund, which is normal. I have had people come and approach us before and they act like they hate VCs. And it's like, well, why are you coming here for funding then? And it's like, you have to understand the model. Like, I can't help the fact that I have to return money to my investors. Like, that's the job. So first of all, you need to know the economics of what I'm looking for. So if you answer the questions for me before I don't have to teach you, we're way ahead. The other thing is venture capital generally is looking for somebody who has an innovation that they can get IP, they can protect their intellectual property, right? And that it's different enough in the market, nobody else will copy it, and no one else has done it. It is not usual that we would invest in something that's exactly the same as everything else out in the market, right? There could be a couple other players who broke the ceiling and started opening the door, but we're usually looking for somebody who is unique in the market, so we know that people are going to want it, that there's great technology infrastructure that's going to help it scale. There are some exceptions, but most VCs are looking for like something that's got a strong technology that will help it scale. Product businesses are harder to get venture capital funding for because it's harder for us to see the scaling without huge amounts of capital investments. And then there's metrics for every industry. So if you go look at who else has been in a space that's related to yours, what are the metrics that people look at to measure them? And what are the exits that they've had? And what are the multiples of those exits? That makes sense? I know this is getting pretty technical, but if you prepare well and you know how to put together a good, what we call a data room, which is just like, I need to be able to see your org chart and your cap table and your financial projections and those kinds of things. If you know how to set it all up, you're way ahead, and I'll have more confidence that you're a good CEO. The other thing is, as a leader, venture capitalists are looking for people that they think are good leaders that will pivot when things get challenging, and good leaders that we believe are going to be coachable. So I've had some people that we've talked to before, they're so protecting themselves so much, they come across as quite prickly. And when times are tough, how am I going to coach this person? Or if I invest in your company, I have partial ownership and we have to be partners. And if I don't think you're going to be honest or authentic with me about what's really going on, it's going to be much harder for me to be able to be a good partner for you.
Excellent. And I love a lot of the checklist-like list you gave, because it's easy to say, okay, do I have this right? Do I not have this? Couple of points I just want to double click on in that discussion. One is, you mentioned exits, you mentioned multiples. Just for those of us who are not as familiar, can you just talk briefly about what would be a good exit, like a win for you from a VC standpoint? And then also what a good multiple would be, and how would I find that as a founder?
So let's start with, what is an exit? An exit could be you sell the company. An exit could be you have an IPO, a public offering. Or an exit could be what we call a recapitalization. It could be like a private equity firm or somebody coming in and saying, we're going to buy up all the interest of the current investors, and they're going to get a certain kind of return, right? So those are examples of how you think about what an exit would look like, right? It's some event where I get my money back, okay? And then I make money. A 10 times return is what I'm looking for. I won't invest in something when I can only see a 3 times return. If I get a 3 times return, I generally am doing okay for my investors, but somebody's going to go out of business. So I have to be able to see a 10 times return. And definitely, people talk about the unicorns, like the 100, 1000x. Like, if I could actually see that this company is going to really scale fast and I get to be a supportive champion along the way, that's fantastic. So I think that's how you want to think about it. You know, you asked earlier, what should people be looking at when they're looking at a venture firm? You want somebody who, frankly, you trust. You will have to raise more money. You will have challenging moments. Something's going to happen with your co-founder. You should just plan to expect that. Do you feel like you can call up that VC, me, and say, hey, Julie, like, this thing is happening. What's your advice? Or I think we need to raise more money, or whatever. And you need to make sure you feel like they're going to be a safe person who is not going to make you do a lot of extra work. They're not going to abandon you or call their money. Like, there's all kinds of things that can happen that could be quite aggressive. You want to just make sure that they have a good track record and that you believe that they're going to be a good partner for you. A lot of people will say that they bring a bunch of resources to the table for you. I actually take that very seriously, and I do that, right? I helped one of our portfolio companies get a $10 million contract. I helped another get her largest enterprise client because I have a big network. Now, what's interesting is I can do that for all of my portfolio companies, but they are not all ready for me to help them. And they don't all have the capacity to be able to follow up well and to close the deal immediately. But that said, you want a venture firm that actually does what they promise and has a track record of doing that.
I imagine that one of the ways you do that is you talk to other founders who have been funded by these venture capitalists. So that's clearly like a tangible proof that they're going to follow through. To what extent do you recommend, especially for the case of women founders who may be getting funded by other men, how do you gauge trust? And how do you gauge that, for example, this guy is not going to sexually harass me, for example, or is not going to dismiss me as somebody who's not a serious player? There are a lot of these biases you talked about. How would I, as a founder, protect myself and the value of my firm that I'm building in that case?
Well, first and foremost, ask other women founders, where have you gotten money and who was a good player? But that said, if you're a grown-up, like you and I, you usually meet someone quite a few times before they invest in your company. In my case, it's usually about 4 meetings. you should be able to tell if I'm going to sexually harass you or talk down to you during those 4 meetings. So if you're a wise, mature person and you're not desperate, which unfortunately we all get desperate. We were trying to raise money on a timeline and gets a lot of no's. It's just keeping your eyes open. Obviously, you can ask around and get references and stuff. So,
and then one other question I want to drill down on in terms of the exit. I know on your website you have a clear 5 to 7 year path to exit. And it sounds like that's pretty normal. So what does that mean to a founder in terms of the strategy they pursue? If you're very clear that it's a 5 to 7 year exit, what kind of milestones should they expect to have hit by then? And how does that typically impact the strategy that they'll follow in building that firm?
We do seed investing in our second fund. You're not going to have an IPO within 5 to 7 years. Usually it could happen. So you need to understand that venture funds have a life. I raise money from people and I tell them in 10 years, you're going to get your money back plus all the earnings, right? So it's my job to make sure I can see that if I invest in year 1, I might have a longer runway. But if I invest in year 3, we got to go fast. And so it usually means you're going to sell the company to somebody. Now, there are a lot of times when somebody builds a company and they fall so in love with their mission and their team and building a great culture that they do not want to sell that company. They want to have that company for 30 years. It's not always a venture backable company if you want to have a company for a long, long, long time. Now, most companies sell. Some of them end up going to a public offering, and that's a little bit of an exception. So I don't think we need to kind of get too caught up in that. You have to be a true believer in your product, but you also have to have maybe just somebody who's your partner in helping you really say, yes, and what if? Or let's come up with some scenario planning. I need to believe that you get it. You know, one company we invested in, and she had a really hard time with a whole bunch of things that were out of her control. They had COVID-related stuff. And she got scared. And she started cutting and cutting and cutting. I was like, okay, you can't cut to success. You will not meet my venture return objectives by cutting. So it's time for you to get some therapy, go out into nature, and let's think about going big again. I know it's scary, but this is what's required.
From listening to you, it sounds like the 2 big goalposts are you've got the window, the horizon of 5 to 7 years. As a founder, you got to keep that really front and center. And then the other goalpost is you've got some size or value milestone that you have to hit that maximizes the chance that you're going to get acquired for some target number, which is probably based on a multiple for that industry. Am I getting it right?
Yeah, exactly. So, for example, some industries, they'll have numbers that you can sort of look at as industry standard that if you fall below that number, like you should have a certain number of customers that have multi-year contracts, or that you should show a track record that the majority of the people re-up. If you lose a lot of clients, that's a problem. And now every industry is different, so you can't say one size fits all. But generally, you need to know, like, what are the indicators this is a healthy, successful company that hit the market well and people trust it. I'll give you a simple example. Like, if you have a product company and I go on Amazon and you're on Amazon and you have a 1-star rating, that's a bad sign, right? Before you go to a VC, you better make sure you clean up all those things.
Yeah, okay. So then moving a little bit again into funding and fundraising scene, right now the market is pretty bad, right? Even macroeconomically, you see inflation is pretty high, but more narrowly to the funding side, VC funding has just dried up. Now, you found a company when you found a company because the market, the timing is right for you, there's proper demand or whatever the case might be. Question is, as a founder, and you have to ride these waves of good and bad funding markets, what advice would you give for them as they're starting out to ride these waves of good and bad funding markets?
What's so interesting is like everything has a good side and a bad side, right? So before this most recent dip, we're in 2023 right now, but in 2022, the stock market crashed and stuff, and inflation started to happen significantly. Before that, what we call the valuations of companies were too high. So usually you'll say, okay, your annual revenue is this amount. Therefore, we could multiply it times X, and that's sort of what your company's worth. Well, people were getting ridiculous and saying, oh, it's worth $100 million. And you're like, that doesn't make any sense. But there was so much money in the venture system that people were investing in those companies, and you couldn't really get in as an investor if you wanted to make sure that you thought that looked reasonable. So this is a market correction that's been happening in the last year, and valuations are being tempered. And I think it's not a bad thing. It's actually good for the venture investors who have capital to invest. And so I just think markets go up and down, and it all depends. There's historical proof that during an economic downturn, that's where a lot of people, we got a massive set of layoffs in the last couple months, right? Everybody's laying somebody off. Amazon, Google, everybody. That means you got all these brilliant people who might have had a business idea for 10 years and finally have the time to do it. And they're going to start the next Airbnb, because Airbnb started in 2008, 2009 when that economic downturn happened. So there's an explosion of innovation that can happen in this kind of a market as well. But those companies usually are going to start coming to venture funding, not the day they get laid off, but there's a little bit of a lag. So we're going to see this year. Last year, I was not seeing innovation. I was seeing the same company over and over. It was kind of interesting because I've been in this game long enough, but now I'm seeing a lot of cool, innovative, really good companies starting in January, really.
I mean, certainly it's great for the investor, right? Because your deal flow just started to look super attractive and the valuations look great. So that's good. But even on the founder side, even though it's a tougher environment to get funding, what it's telling me is, to the extent you're innovative, to the extent that you're truly building a game-changing company, it shouldn't dramatically change things. And I assume that I'm adding on a corollary, which is that if you then have cash to ride it out until the valuations are more equitable or feel fair to you and to the investor, is actually a good thing. So,
I mean, a venture fund like mine, we raise money and then we invest it over the next 3 years. So venture funds didn't run out of money in the crisis. I mean, some of them weren't able to raise their next fund, but there's still plenty of money out there to raise.
It's very interesting, but I love the perspective that you gave about it. Now, I want to narrow the focus a little bit and talk about women founders of color. You mentioned that half of your portfolio comes to non-white women, which, particular focus for me in this podcast. What are you seeing in terms of additional issues they face? And what have you seen work well for a woman of color who's listening to this to improve her chances of building an investable company and actually getting investment in it?
Okay, well, if there's a lot of bias for women, you just layer on somebody who has an accent, somebody who people have beliefs around, somebody like, I'm a white woman, but I'm married to a Mexican. And our 30-year-old daughter's freaking amazing. She's a violinist, a classically trained violinist with a conservatory degree, a performance degree. I say that to say, who is that young woman? Well, she's not wild and crazy. She doesn't have purple hair and she doesn't have tattoos. She's a conservative classical violinist. So she's working in one of the largest tech companies in the world. And some 60-year-old white guy comes up to her and says, what's so weird is she looks exactly like me, but he was like, oh, you're the hot-headed Latina. And she calls me up and she's like, Mom, this creepy old guy said this thing to me. And she was like, why would he say that? Because I'm hot-headed and she's not. Let's be clear. And so he was supplanting his ridiculous bias on her. So if he's going to invest in somebody's venture-backable company, do you really think he's going to invest in her company if he thinks she's a hot-headed Latina? He doesn't know anything about her, but he decided. So what her job would have to be then is to convince him otherwise, which is ridiculous. So I guess I would just say, if you're a woman of color, find women of color investors. They're not going to have that bias about you. Not likely, less of a bias, let's say, because we all have biases still. It's harder to pitch to the guys. And I think you got to get your fundamentals super, super tight. No one's going to give you any room to make a mistake on your financial models or anything else. And what we know is women of color, they return a lot of money to their investors because they have to be the best of the best. So I wish I had a good solution, but this is what I want to say. Tell every woman of color friends, we got to start investing in venture. Even if it's modest, we got to start playing in this game or none of us are getting funded. I think that's my call to action today is tell everybody and get them involved.
So one other little thing on that, which I think I know the answer, but I'll ask you anyway, is have you seen any blind spots or any potential self-defeating issues on the part of women of color?
No. I mean, this is the thing. Women of color are not monolithic. Immigrant women, by definition, are more risk-taking and have a courageous underpinning. They have some perspectives that are unique that make them fantastic founders. Immigrant women sometimes feel less than or discomfort because they might not know all the systems in the United States or feel like they're at a deficit in terms of language or something. But American women of color, someone who's multi-generational, can actually have a lot of internalized oppression of some sort. I have it as a woman in the United States. And if you're a woman of color in the United States, and like my daughter, like those microaggressions add up. And I would just say, like, if there's any way you can go to therapy or get an executive coach and get over that, you'll be better off, because we all have self-fulfilling prophecies. If you think, like I've had someone say to me before, a Black woman said to me, there's no way I'm going to get venture funding, but I'm going to try anyway. It's like, I understand where it's coming from, but we got to do that inside work so at least we don't become one of the barriers.
Are there resources to any women founders, women of color, other minority women, in terms of learning more about?
I was going to say, like, capital access looks like a lot of things. So there are resources out there for revenue-based financing where you can get an investment that is essentially a type of a loan and that you have to pay back off your top line revenue in a reasonable amount of time. That might be right for you. Like if you have a big customer that you're trying to close, but you need money to be able to fulfill that customer's purchase order, for lack of a better word, you can actually go to that company and say, hey, would you either give me a loan against this purchase order or prepay it so I can start to scale? And a lot of them will do that. We also have a couple of new crowdfunding type of resources out there. Now, crowdfunding is not easy, and so this is not a panacea, but there are new tools out there that I think are good alternatives and might help you not have to experience the pain in this game. That said, in the last 5 to 10 years, but really 5 years, we've had an explosion of women and people of color run venture firms. They're trying to fund you. And so researching them and finding them and going to them is always a good idea. Now, they could be great investors or bad investors just like everybody else, but at least you can count on them not having some of the same biases. They might have other ones, but I guess that's I wish I could say it's a new day and everyone wants to fund you, but that's not my experience yet.
No, we want to be real and we want to be constructive. So you're spot on with that. It's funny. I'm just going to ask you one thing on that. I read research recently that said that if you are a woman founder who's funded by a woman VC, there was some research that said that it's going to be harder for them to get subsequent rounds of funding because of this implicit.
Yeah. Listen, the methodology, it wasn't very robust. So we all saw that article and people decided to believe it. And I'm not sure that that's the right thing for all of us, but let's just assume there's some validity to that, which I'm sure there is. I think we just need to change it, because what does that suggest? You shouldn't go to the women. You should keep beating your head against the wall with the men. Like, I don't think that makes sense. It's all part of this whole broken bias structure. So I'm going to go back to my same broken record. Go tell every woman you know to start investing in venture. Just get them playing in the sandbox.
So lastly, you've just been extraordinarily generous, authentic, and helpful with everything you shared. If there is one principle that you would offer to founders to take away and to guide their startups to success, however they define it, what would that one guiding principle be?
I would just say balance between working hard and then taking enough of a break to have perspective. We've all had those days and we've all met those people who are just spinning. And you have to have times when you're not spinning so that you can be strategic. You can get out of the weeds. You can think about the other person's perspective. If you're going to come to me as a venture investor and you don't know anything about me and what I'm investing in, if you haven't done your homework, if you show up in a panic late or otherwise not prepared, those are really bad signals. And so just get rest and balance and perspective, because it's a hard game. You get told no a lot. And so you need to be ready for that. And you can't just, I just think keep perspective, hang in there. The world's not fair. I'm sorry. It just isn't. So we're working on it. It's not quite there yet, but we're trying to make it better.
Fantastic. Thank you, Julie. I think that's wise and practical counsel. Thank you for a really amazing conversation. I'm sure I have taken a lot of value from it, and I'm sure many more do. I love the personal stories. I love the story about your daughter. I learned a lot from your story about the corporate board. There's just so many more little nuggets in there that I know many will appreciate. So thank you so much. It's been a pleasure.
Thank you, my dear. It was fun to spend time with you today.
Julie has a unique vantage point at the intersection of venture capital, corporate governance, and entrepreneurship. So what about her perspectives stood out the most? First, the good and bad news about representation of women. It's thrilling to hear that when more women sit on corporate boards, those companies recall bad products faster, saving potentially thousands of lives. But the bad news? It takes the force of law to make that happen. So the question for us is, should we be the change we want to see in the world, or should we work to mandate it as law? The other thing I liked was how important it is for founders to understand what getting VC funding means. If you want VC money, you have to be ready to play by the rules. This means hypergrowth and a fast and large exit. If these aren't your cup of tea, then seriously reconsider your desire for VC money. Last but not least, this chat framed very clearly for me how important it is for founders to have a few key stats right at their fingertips. For example, your exit horizon, exit multiples that are common in your industry, and the best acquirers for your startup. Do your startup a favor and make sure you know these like the back of your hand. So, what one step will you take to make your startup more capital ready? Thanks for listening to today's episode. We have show notes and more at achieve.co. That's ACHIIV.co/podcast. Like what you heard? Hit subscribe and share with a friend. See you on the next episode. Now, go be an achiever.